Hi friends, Simit here from InformedTrades.com. In today's video, we're going to discuss the fixed income investment strategy known as laddering, what that is, and how investors can use it in their strategy. Let's get started. Okay, key points. We'll start by defining what laddering is. We'll take a look at the benefits of laddering, which are basically to reduce interest rate and liquidity risks, so risk associated with interest rate changes and loss of liquidity. And the cost of laddering is basically you're accepting a lower yield in the short term. Okay, so what is laddering? It's often easiest to explain it by going through an example. The laddering can be defined as investing in fixed income investments with different maturities. So having a portfolio of fixed income investments that have staggered maturity dates. So you can see that on the screen now. Let's imagine that, year one today, an investor buys 3 bonds. We can sort of ignore bond 4, 5, and 6 at this time. They have 3 bonds in their portfolio. The first bond matures in 1 year, meaning they get the principal back in 1 year. The second bond matures in 2 years, and the third bond matures in 3 years. As we know, bonds with a longer maturity date or a more distant maturity date tend to have a higher yield. So that third bond that matures in 3 years is going to be paying 6.5% a year. In this hypothetical example, that first bond that matures in 1 year is going to be paying 6%. Now, after a year, that first bond has matured, so you get your principal back, and you invest that in a 3-year bond. So that means by the end of year 4, meaning 4 years from now, you'll get that principal back. So the idea here is that, and then with year 2, you do the same thing. You invest in a 3-year bond. In year 5, after the 3rd year, when you get the 3-year bond principal back, you invest in another 3-year bond. So the idea here is that you're setting yourself up where every year one bond is maturing and you're getting that capital back, and you can reinvest that. So every year you're getting capital back. Now, one of the things this does is, let's say you invested, or one of the things that helps you mitigate against is, let's say you didn't have this. Let's say you invested, day one, you invested in all long-term, 10 years out or whatever. Now, if interest rates go up, then the price of your bonds is going to go down, as we talked about that in our video on the relationship between the price and yield. So by laddering your bonds, you become you reduce your risk to interest rate changes, right? If you have all 10-year bonds and interest rates go up, the value of your portfolio can decrease significantly. If you're laddering, then some of the bonds that are short-term, you're able to adjust and reinvest them in a higher interest rate. While the bonds at the longer-term duration, they're going to still decline in value, but at least you have those short-term bonds that help you reduce your interest rate risk. And related to that is liquidity risk, right? So if you're invested, you put all your money in 10-year bonds or 15-year bonds or whatever, and then 2 years from now something happens and you need capital immediately. Let's say there is a personal crisis or issue of some type. And then you're in a bind, right? Because then you have to try to liquidate your bonds. You may not get a good price for them, especially if interest rates have gone up. So laddering can help you reduce your exposure to interest rate risk and reduce your exposure to liquidity risk. And that's sort of the idea here. While it does help you lower those risks, the trade-off is you're going to have to get lower yield on those short-term bonds. So if you invested all long-term bonds, you get a higher yield on that. But by helping to mitigate your liquidity risk and interest rate risk by having a portion of your bond portfolio invested in the short term, you're accepting a lower risk to give you that flexibility. And that's sort of the trade-off. Laddering is basically a way of creating a diversified portfolio across maturities. And the idea here is to structure your portfolio in a way where each year you're getting your a principal one item in your bond portfolio is maturing and you're getting that principal back. You can reinvest that. That's about it. A pretty simple concept, but it can work really well. Any questions you have, anything you want to add, join us at InformedTrades.com. Best of luck in your trading and investing, and we'll see you next time. Take care.